that in the last few months, we've seen a rapid outflow from the COMEX warehouses to wherever it's flowing. I would suggest some to the LBMA, and I'd say most of it from, I think, everything that we that follow the silver market can determine on a best effort basis over into Asia, into the Shanghai Gold Exchange, Shanghai Metals Exchange, the Asian market, and India too as well. So those two markets. So the idea that you can just look at what the open interest is and how many people are standing for delivery, you got to take it with a bit of a grain of salt, because even though those deliveries are valid, many of those inventories and exchanges really don't move the overall supply in the COMEX. That's my point.
Silver is quietly shifting from west to east, marking a key market signal today. Physical flows tell a different story from paper metrics, highlighting market divergence. This divergence could drive the next major price move. David Morgan observes that silver has recently flowed out of the COMEX, much of it likely headed for Asian markets like the Shanghai Metals Exchange and demand centers such as India. Traditional indicators like open interest and delivery data remain useful, but do not reveal true supply dynamics, especially when inventory is merely transferred between institutions or across regions. The main trend is clear. Physical silver is increasingly accumulated outside of Western systems, tightening supply where prices are set. If this continues, a structural imbalance could force prices higher. As global demand rises, the shift in ownership may support stronger price momentum. Now, we present the clips from David Morgan's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
You could see a pallet full of commercial bars, and it says JPM for JP Morgan. And then after the delivery month, JP Morgan is delivered to HSBC. So the tag that says JPM gets pulled off that pallet, and the sticker that says HSBC gets thrown on there. And that's almost literally what happens. Now, not in every case, of course. But what we're primarily interested in is how much silver comes off or out of the COMEX warehouse. And so what we could see in 2025 is we had this huge influx of silver coming in to the COMEX warehouses. We call them vaults, that's what they are. And we saw that rapid increase. Now, some say it was tariffs, some say it wasn't. I'll just say facts are facts. We got an increase in inventory regardless of the reason why. And then it flattened out, and that same amount of inventory basically left the COMEX warehouse for kind of an in, leveling, and an out, and basically back to the starting point where we started in 2025. So we're slightly below that. But what is important, and I think Andy Schechtman has made a point out of this, that in the last few months, we've seen a rapid outflow from the COMEX warehouses to wherever it's flowing. I would suggest some to the LBMA, and I'd say most of it from, I think, everything that we that follow the silver market can determine on a best effort basis over into Asia, into the Shanghai Gold Exchange, Shanghai Metals Exchange, the Asian market, and India too as well. So those two markets. So the idea that you can just look at what the open interest is and how many people are standing for delivery, you got to take it with a bit of a grain of salt, because even though those deliveries are valid, many of those inventories and exchanges really don't move the overall supply in the COMEX. That's my point. I have made the proposition that there will be some point where there's a very strong demand that might not be met or delayed or that type of thing. And we have already seen that occur a few times. I mean, Andy Schechtman of Miles Franklin has talked about a point in the retail market where he could basically not find any silver for retail products, and that I turned him on to an outfit that was in the industrial side called Pyromet. And Pyromet was making 100-ounce bars that were not the best looking bars ever, but that was, I think, if I recall correctly, about all he could source for a while as far as silver product. Now, that subsided over time. But we've also seen on the commercial bar side, I remember, I think it was the second tranche that Sprott Asset Management bought for the PSLV. And if I recall correctly, it was 22 million ounces, I believe correctly. And the silver was delayed, not by a lot, by a few weeks. But nonetheless, the demand delivery date was not met. A lot of it was, but there was still, I forget how much, 5% or so that had not met the delivery date. They came in, and so I got pretty excited. Aha, they're very short on commercial bars, which is really the silver market. I mean, retail is very important, but it's a derivatives market based on commercial bars. So that's what I focus on. I focus on everything, but that's the one to really see what would occur as far as a quick movement or a quick adjustment in price. Because if you couldn't deliver 1,000-ounce bar, that would really throw a wrench into the gears, so to speak. So I thought, aha, that's it. Well, a year or two goes by and they have another tranche, which was, I think, greater than that one. And, they delivered it early. So, I mean, the silver market does ebb and flow. And there is always, more mining, more recycling. And sometimes the market is very tight and sometimes the market isn't so tight. So not trying to be too long-winded, Elijah, the overall trend is very clear. We're using up more than we're mining. We're using up more than we can recycle. So somewhere down the road, that's going to occur to a point where it's going to be very tough to meet the demand without a big increase in price and someone willing to sell silver, for fiat. And that's what we've already seen. We saw that in January. And I think that we're going to see it again. And I think the next time that we see it, we could, and not would, but could get in a situation where we get information, which you've already seen before out of the LBMA, that they're down to this much and they're going to hold deliveries off by 6 weeks because they can't meet the demand in that amount of time. So it's a very dynamic market. It does ebb and flow, but the dynamics, the trends are all in favor of silver investment.
Silver flows reveal a deeper shift where physical movement governs markets more than paper indicators. Warehouse activity is now more about direction than volume. That direction is away from Western exchanges. Recent data shows that large volumes of silver entering vault systems like the COMEX have not translated into lasting inventory growth, as much of that metal has flowed back out in a relatively short time. A significant portion appears to be moving toward global demand hubs, including Asia and India, where physical ownership is tightening supply. At the same time, much of the reported delivery activity remains internal transfers between institutions, meaning the true available supply is not increasing. Occasional delays in fulfilling large orders and tightness in sourcing commercial-grade bars hint at underlying strain. While the market continues to ebb and flow, the broader trend remains clear. Consumption is exceeding production and recycling. If this imbalance intensifies, future demand could face delays or shortages, forcing prices higher to attract supply and rebalance the market. Let's get back to the interview.
You look at a chart of silver's price and other war situations, you'll find actually the trend is counterintuitive. You get in the war cycle and you actually see the silver price go down for a while, and then you can see it bounce back. The reason is not an absolute, but the best determination I think is valid is the whole system still runs on interest rates. It runs on the treasury bond market of the United States. That's the primary source of what everyone trusts. I'm not just talking citizenry, I'm talking primarily the broker-dealer relationship in the central bank system relies on the U.S. dollar. So when things get wacky in a war situation, rather than go to gold, which would be expected, they go back into the U.S. dollar. And that's in the form of treasury bills, treasury bonds, treasury notes, dollar itself, currencies moving out of foreign currencies into the dollar, and that type of thing. And I'm pretty sure, in fact, the data shows that is what has occurred. And so that took gold down. Plus, honestly, to be objective as I can, gold, especially silver, got a little bit ahead of itself. I mean, look, in January of 2026, silver went up about 70% in a month. I mean, how many times have you and I done, interviews together and, silver moved, 10% for the year or 20% for the year. And now we're seeing 70%. So it was overdone for a while. It's recaptured its bullish trend, and I think we're going to go up again. But I also think we have consolidation to work off the large increase that we've seen. And I'm pretty convinced we're going to see a sideways action in a trading range for both gold and silver for probably 6 weeks or thereabouts. Could go longer than that. I think that gold hit the 200-day moving average and bounced off it pretty strongly. And gold is still going to lead this market, although silver did catch up quite a bit last year, where, gold was at the $3,500 level and silver hadn't done anything. And then after the summer, it started to really catch up to gold. We saw the gold-silver ratio go from, I forget the exact numbers, but from something like 100 down to 60. And we're in the mid-60s right now. I said weeks ago that I saw a trading range between 70 and 90, which is a big spread. It looks like it's going to be more like 70 to 80. These are round numbers. But I also use OCO, on close only. I'm not trying to get too deep in the weeds here, but the way I've traded them, used to trade a lot more frequently than I do now. But at that time, I was taught the intraday moves are important, but it's on the close, OCO, on close only, that you really want the data. And I've integrated that. So if you go to OCO, you'll find that 70 number is pretty valid. You'll see those 60 prints during the day on the close. Most of them are above 70, not all of them, but when you're doing a channel formation, it's not a perfect up and down in a perfect range. It's, again, an art form more than a strict, principled math formula. But nonetheless, you get a pretty good feel for it. So I think we're doing exactly what I would expect at this time in the market. And unfortunately, in my opinion, the people that were late to the party or maybe bought it at 50 and watched it go to 100 and didn't get out, or people that are on leverage, or people that expect silver to, make up for all the mistakes they made in other investment arenas and what have you, are expecting too much. So the market going sideways will wear them out. And they'll say, you know what? I bought silver, cost me this much. The spread is this much. I'm kind of just breaking even. I've held it for, 4 months. I'm tired of it. I don't like it. I'm going to get out. And those people, the weak hands, as we call them, leave the market. And once that happens, I shouldn't laugh, but I've been there, done that. We will see the market take off. No, I'm talking about the silver price. As far as the gold-silver ratio, is a good question. Yeah, I think that might vary between like 60 and 70. I don't think it's going to get very extreme here. I think it's going to maintain its ability to do better than gold, from the top. In other words, when the gold-silver ratio is at an extreme and you could have, should have, might have traded your gold into silver and then maybe traded back at 50, which was the first alert that I gave to my members, my paid members. I said, look, if you want to swap into gold, don't swap it all at 50, but take a tranche, 20% thereabouts, as a suggestion, and move in the 50 range into gold, and several did that. Yeah, thanks for backing me up on that. I mean, it's not something you can do all the time, but when the advantage is there, it's 100 to 1, and just think about the people who did that were maybe all silver or too much silver, however you want to frame it, and it went from 100 to 1 to 50 to 1, all of a sudden they doubled their gold position. Of course, there's, fees and all that, so it's not exactly double, but in theory it's double. And, gold's a lot easier to, stack, and, it's a lot smaller volume. And I always have taught that you should have both. They really serve different purposes. And silver, as we all know, is just much more volatile. But to make that trade when, you're kind of tempted to buy gold and it's getting all the news headlines and the institutions are buying gold and central banks are buying gold and gold. But you look at that ratio, man, I'm going to buy silver because I want cheap gold. And you buy it 100 to 1, then it gets to 50 pretty quickly when it moved. And you swap that, you feel pretty happy. You bought gold basically at half price.
During geopolitical stress, silver often initially weakens, but then follows stronger long-term uptrends. Market reactions are being driven more by liquidity flows than traditional safe haven logic. And this dynamic is shaping the current consolidation phase. During periods of conflict, capital frequently flows into the US dollar and treasury markets rather than immediately into precious metals, temporarily putting downward pressure on gold and silver. This effect is amplified when metals have already experienced sharp rallies, as seen recently with silver's rapid surge, which required a cooling phase. current price action suggests a period of consolidation, likely lasting several weeks, as the market digests prior gains and removes weaker participants. At the same time, gold continues to lead the broader trend, with silver following and gradually improving its relative strength. The gold-silver ratio has tightened significantly and is now stabilizing within a defined range, indicating a healthier structure for future upside. Once this sideways phase exhausts weaker hands, the next move higher could unfold with stronger momentum, particularly in silver. Share your thoughts on his interview in the comment section below. If you found this market analysis valuable, please support the channel by liking this video and subscribing for more exclusive precious metals content. Don't forget to hit the notification bell to stay updated. Thanks for watching.